This is the first liquidity event online. I want to thank everybody that's going to be watching now and in the future. I do have somebody that I really admire their skill set, and we've been working together going on 3 years now. I was first introduced to him by one of my mentors, Doug Andrew, who introduced me to Ross Brunson, who then introduced me to Braden Chase. Braden is the manager of Business Structuring Secrets, LLC, specializing in protecting, optimizing, and growing the holistic wealth of entrepreneurs and investors. Business Structuring Secrets, LLC, offers entity formation in all 50 states, privacy and asset protection, tax strategy, and trust execution. Of course, Braden is going to go through his very need to know presentation. If you have any questions, just hit the hand raised feature at the bottom of your screen or at the bottom of your phone, and we will give you the opportunity to ask Braden those questions. All right, man, go ahead and take it away.
Okay. All righty. Well, thank you. So welcome, everybody. My name is Braden Chase, like Randolph was saying, and we do structuring. Most people kind of go, what does that mean, right? So we bring your LLCs and your S-Corps and your trusts and all these different things that people have, all of these entities that exist, these legal entities, and we bring them into a cohesive whole, right? And there's no degree for this. There's no certification for it. There's no classes you take on this stuff. This is personal search and find and discussion and pay lots of attorneys. I have quite a few attorneys who are my clients. I have CPAs who come to me as clients. The people that you would expect would know these things, they don't. They come to me to have me do it. And this is what we're going to talk about today is something that is very atypical. There are certain people that this applies to and certain people that it doesn't. And it's okay. If you're not the type of person that it applies to right now, if you're in Randolph's group and you're under his tutelage here in this organization, you probably will be soon if you're not there yet. And it's unique. You won't see it often. And we're kind of going to jump into this one here. I wanted to let's see, let me get the right buttons here. Allow to share screen. I'm going to share this screen over here. Do you guys see happiness can be found, right? I can see it. We all see it. Okay. Dumbledore, right? Very important quote for everybody.
Yes.
And let's kind of hop into this here. So the way I titled this was the $15 million tax break your CPA didn't tell you about. Now, CPAs often know about this, but they don't ever talk about it. And it's kind of crazy to me that they don't ever talk about this stuff. So who am I? And what are we doing here? I am the manager as Randolph was explaining, right? And we do things in all 50 states. One of our core components that we've had to build into this was the legal education part of things. For a long time, we just did the structuring. But over time, it's become very apparent that there is an educational component to this that is fundamental, because I can set up the perfect structure for you and outline everything, have the beautiful floor plan of all the different things in the right place and everything's right. And then you step in, not understanding things appropriately, and then you'll step on a landmine, right? These legal landmines that the IRS or the Senate or the Congress, whatever, have put in your way to blow everything up and all of your hard work. So there's get the structure, there's get the entity, but there's also the, how do I do this? Like, how do I maintain this over time? There's all these things going on, okay? So that's the kind of our educational component. And tonight is mostly going to be education, right? That's what we're going to be talking about, this specific thing. It's section 1202 or 1202. And one of the things I have over here on the right over here, why am I here? So I've been an entrepreneur since 2006. I have been in and out and up and down, and I've made good money, and I've made very, very little money. I've been in multiple countries. I ran a business out of Brazil. I ran a business out of here. I did, multiple states, all these different things. And as I was running around with everything, I started learning bits and pieces. I was like, oh, that's how that thing works. That's interesting. Oh, hey, there's this other thing over here. That's nice too. And I'd read all these books and watch YouTube videos, and I'd talk to different people, and I'd pay these CPAs to educate me on stuff. And then they'd say this little bit and that little bit. I started just kind of gathering these things together. And I had kind of this chunk of stuff. I'm like, hey, I get it now. And then I met Ross. And Ross said, hey, let me show you the whole new world, right, of all of these things. And a lot of you guys don't know Ross, and that's fine. Ross Brenson is serial entrepreneur, real estate investor, makes a lot of money, but he's very, very quiet. And he's very kind of keeps to himself, owns a lot of real estate, and he just helps people all the time. He has, I'm going a lot of different directions about Ross. He's a pretty awesome guy. But he was the one who started me down this track of setting up these entities and doing these things, because he, through a similar story to me, had developed a lot of knowledge that most people didn't have. And he was willing to share. And he said, hey, how about Braden? I teach you my stuff. I'm going to retire. He's 73 this year. And he's like, I'm going to retire. I'm done. I have more money than I know what to do with. And I don't need to do this stuff anymore. How about I teach you and you carry on? You continue my mission to help other people grow, to grow their holistic wealth, as we call it, right? Not just your financial wealth, but also your family wealth, your generational wealth, the family relationships. How do you incorporate these things for this year, for right now, but also for the next 10 years or the next 10 generations, right? How do we make this stuff work? So what are we going to jump into, right? So what is this presentation, right? We're going to talk about all these things, particularly this IRC section 1202, right? This is, I will refer to it as QSBS almost always throughout here. I've got it written in here, IRC section 1202. Most people don't know what that is, right? It's kind of an odd vernacular to use. So we just call it QSBS, right? That stands for Qualified Small Business Stock Exemption, right? You don't put the E on it, right? But Qualified Small Business Stock Exemption, QSBS. We're going to talk about that. We're going to talk about it in very plain English terms, right? We're going to keep it very simple, very straightforward. Landmines, I've got analogies, I've got a bunch of things to kind of understand what this is, because it is very technical and very unforgiving, right? And how it works. But conceptually, it's so beneficial if you can figure out what's going on and then apply it to your situation. It can be untouchable as far as tax strategies are concerned. It's amazing. Okay. So my hope is that by the end, you'll be like, hey, I get this. Maybe I don't know all the technical everythings, but I get the idea and I get the strategy. And now I can take this and approach my CPA. I can approach Braden. I can approach Randolph and say, hey, how do we incorporate this thing? Because I have this plan. I have this goal. I have this thing that I want to do. Let's do it. Right. That's the idea. That's my goal for this one. Okay. So what is the QSBS? Like I said, right, it's Qualified Small Business Stock Exemption. And there's a big pivot point between before the One Big Beautiful Bill and after the One Big Beautiful Bill, right? It's been around since like 1993, I think, right? So it's been around for a while. It's not a new code, but they made some adjustments to it in July of just last year. So basically, it was a $15 million stock exemption minimum, right? Was going on there. It was huge up until July 4th, 2025. And now they've actually, I think, improved it. Some people didn't like it, but I think it's improved, where they have kind of tiered layers to it, right? Where instead of it, you have to meet all the criteria. And if you meet all the criteria, you get 15 million. Here you go, right? Happy day. Now, 10 million is what is pre One Big Beautiful Bill. Now, post, it's scaled, right? It's tiered. So you get 50% here and 75% there, and then 100% here, but based on what? What are we talking about, okay? So in that last little paragraph I've got right here, the practical takeaway, right? A brand new C corporation. This is important. What is a C corporation? I'm not going to get into all the details, but like it has to be a C corporation. It can't be anything else. It must be a C corporation. All of these other things, recapitalizations, right? Pre-issuance basis, all of these different variables are important things that are attached there, but you have to have those things. You must have a C corporation. If you don't have that, you're dead in the water. Okay. All right. Next, plain English part of this, right? So you have to have an original issuance C corporation stock. Okay. And this is important because the actual exemption is tied to the stock. right? It's not tied to the entity, it's not tied to the assets, it's not tied to the business domain that you belong in, nothing like that. It's tied to the stock of the entity, which means who are the owners, right? Who owns the stock of that particular C corporation? Those are the people who get this exemption, not anybody else, none of the employees, nobody gets any of that. It's only the stockholders. Okay, so that's kind of part one. This is also not a deferral, right? We're not pushing the taxes away. We're not getting a credit back on it, nothing like that. This is a permanent, complete, and total exclusion. You buy this business or you build this business and then you sell it, right? And when you sell it, there's going to be taxes on it. Oh, wait, if you qualify for this QSBS, that income up to $15 million is simply excluded. They just won't count it, right? Put it in a box, sign it, done. It's just not part of the math. Very few exclusions exist in the IRS code, and this is one of them, and it's gigantic. So, what's one of the rules that's at play here is that when you get that C corporation, right, you get it set up, you have to hold on to it for 5 years, right? So it's not like, oh, hey, I got one. I started a C corporation. Now I'm going to sell it tomorrow, right? You're not going to get anything out of that. That's not allowed, right? It used to be a minimum of 5, right? Now it's a minimum of 3, right? This was one of the changes on that one big beautiful bill. But if you do it only to 3, then you only get 50% of the exemption. Now that can be pluses or minuses. That could be good or bad depending on your situation, but just so you understand, there's some variability there. The key is you have to hold on to it, right? You have to hold on to it for an extended period of time and then sell it. Okay, that's the key component there. Okay. Years of planning, right, going on here. Next, so how do we know if we qualify, right, if we are eligible for this one? First variable, is it a C corporation, right? I already said that, but this is important. That's gate 1 that I have over here, right? Gate 1, is it a C corporation? Yes or no? Okay, is it an LLC? You're fired. Is it an S corp? You're fired. If it's a partnership, you're still fired. If it's a trust, no. None of those things are allowed. It has to be a C corporation, okay? Gate 2, original issuance. Okay, this is a key component. That means the stock, the entity exists, and the very first people who own that stock, they get it. If you bring somebody on 2 years later, they don't get it. Okay, the original issuance of that stock, those owners can have this exclusion. Very important. Gate 3, the aggregate. This is a little complex, but like the gross assets test is what they call it, right? So the aggregate gross assets total of the business must be under $50 million. Okay. Remember, this is a small business stock exemption, right? QSBS. If you're over $50 million in total assets, are you a small business? Probably not. The IRS says no, right? By that point, you're probably a medium to large business. You're not a small business anymore at $50 million of assets. So at $50 million, and it's actually going to, there's some variation to that one, right? So post OBBA, it's 75 million, but even still, right? And I'll get to this later, but it actually can change a little bit. But the $75 million, right, gross assets, if you're below that, then you can qualify for certain things. And again, this is at start, right? So as long as you're under those limitations at the beginning, then you're okay, right? Then we come to gate number 4. Qualified trade or business. Okay, and this is important because if it's like at least 80% of it needs to be wrapped around a business that is a true business and not just attached to the personality or particular certification of an individual. And the classic example of this is, let's say that I am a CPA, right? Because I get CPAs, they ask me this all the time. I'm a CPA and I run a CPA firm. I'm going to set one of these up, and then I'm going to sell my CPA firm. I'm like, you can't do that. One, because your entire business is wrapped around you and your license, right? You can't just sell it off like that. You are the person. The IRS will disqualify you. Now, if you change it, right? Now, there's ways around it. Like I said that it's a hard rule, and it is a hard rule if it's simple. But if you're like, hey, I'm a CPA, but now I've built a team of other CPAs. There's 50 of us now inside of this, $70 million business. I've done all these different things, and I hardly do any of that work anymore. I'm a manager now, even though I still have my license. That's a different thing. Okay. So there's some variation to it. But if the way the IRS looks at it is if you are doing these activities, and it's wrapped around you and your skill and your personality or your licenses, like an attorney or like a doctor or like a accounting people or things of that nature, most of the time you're kind of excluded outright. You would have to build the business very strangely in order to qualify. But if you're something else, let's say, an HVAC company, okay, there's not a whole lot of like licensing that's attached to those kinds of things, or you're a teacher for that matter, or you do construction, right? No single person is building a skyscraper, right? You got to have whole teams of people to do that kind of stuff. Those kinds of businesses count, but a lot of these others, right, won't. So that's the idea. Qualified trader business. Gate 5, holding period. So you have to hold it for now at least 3 years, right? Or best case scenario, 5 years holding that, and then you get 100% of that exclusion. Okay. So most people you will hear them talk about the 5-year exclusion, and that's true. It's not wrong, but there is a little bit of variation on the year 3, year 4, right? Where you can get some percentages on that. Okay. Next, shifting perspectives, right? Let's look at this from, okay, here's the exemption, here's the thing, right? But everything I've said so far is federal. Okay. And as we all know, the United States of America is the United States of America, right? There's a lot of states. We got 50 of them, right? There's all these states everywhere. And they all have their own laws and their own congresses and their own everything's going on. So there's all this complexity. So we have to deal with the federal level. That's one layer to it, but there's also state complexity that's at play. And I've got a little map later on that kind of gives a little bit to this, but basically the state level, most states will simply conform to this IRS section 1202, but some of them don't. California is a notable example when they used to, and now they don't, right? They don't accept this. They just ignore it. This section of the IRS code doesn't apply to people who live in California. Sorry, you don't get to. And there's 4 or 5 other states that are also like that. They just say, no, we're not going to allow that. Good, bad, happy, sad. That's the choice of those particular states to not do that. So 1, you have to obey the federal level stuff, right? If you don't obey that, you're done. Okay. 2, hopefully your state just conforms to it and you're okay. But if it doesn't, that means you're going to have all of those taxes from the sale of the company. You're going to have all of those taxes at the state level. Even though the federal is exempted, you're still going to have some state stuff to deal with. So be aware of that. That's one of those reasons where you do want, one of those situations where you do want a CPA or somebody next to you saying, hey, look, pay attention, right? This thing's going to happen, okay? Then the next layer is who are the actual shareholders, right? Making sure that they are people is the easiest way to make everything work right, okay? Individual, human, living, breathing people own those stock or that stock. Remember, the whole exemption is wrapped around the stockholders and who those people are. So, and if you put the wrong entity or the wrong thing there attached as that stockholder, you can actually break your eligibility. So, for example, if you put another C Corp, right, to own the C Corp stock of the C Corp, right, if you kind of connect them that way, you're going to blow yourself up and it won't work. Okay, so that's an important thing there. So those are kind of 3 levels: federal, state, and then the actual entity shareholder eligibility, making sure all that lines up. Okay, so a little bit more detail on that pre and post. Okay, I have a little table there on the side. Hopefully that's helpful. Basic criteria, right? These are those 5 gates. Again, the holding period. If you have a C Corp, right, and it was created before July 4th, 2025, then even though we are now currently past that point, your entity still has to follow the pre-OBBA rules, okay? So the post One Big Beautiful Bill rules only apply to C corporations that were created after July 4th, 2025. So it's not about the enactment of the act, right? It's about when was the entity created, right? Which makes the difference. So if you're new or you're considering this for the future, everything that applies to you is going to be in that right-hand column. If you have an older C Corp, you're like, hey, you know what? I've been doing this thing for a while. Maybe I can use this QSBS stuff to help me out. You're probably going to land in that middle column there, that pre-OBBA stuff. So that one's 5 years for 100% exclusion, again, which is up to $10 million. And there's actually more, which I'll get into later. The exclusion is 100%. greater of 10 million or 10x the adjusted basis. We'll talk about that. That's a math piece. Total assets 50 million or less. Inflation indexing didn't exist, right? So that $10 million and $50 million gross assets were set at the 1993 level of income, which things have changed. So post One Big Beautiful Bill, we're now at 3 years at 50% exclusion, 4 years at 75% exclusion, 5 years at 100% exclusion. So there's those tiered layers. Then the per issuer cap. It's a funny way of talking about it, but basically, and this is important, the exclusion is based on the stockholder, so it's individual. So if you are a partner or an owner, right, of that stockholder, and then you have another one who's a stockholder, it's 15 million each, right? So $30 million, right, of exclusion. Like 15 million for each of you. So it's pretty cool. A lot of money. And if there's more of you, right, it can be even more, right, as that expands. So it's going to be a lot of tax exclusion across all of the people. So the asset test is now 75 million. Okay. And that's also indexed for inflation as it grows. And then, of course, the index inflation inflation indexing, adjusts, right, over time, every year starting in 2027. So it'll be constantly shifting upwards. And that's important because right now I'm talking about 75 million, 15 million, this amount, whatever. But those numbers are going to be shifting over time. They'll get bigger, right? So that just so you guys understand that those numbers will be shifting over time. It's very useful. Okay. Landmine number one. Actually, one step back. Now that we've talked about the thing you need, right? You have to have a C Corp, right? It must be a C Corp, has to follow all these different rules. If you have all of that, check mark, you qualify, good job. Now it's the next phase of it. How do I not blow it up? How do I maintain this over time? How do I not step on my own feet or whatever, right? So here's one landmine that happens a lot with people. I've explained all those things before, but I have seen so many times where people have come to me as like, oh, they hear about QSBS and this, $10 million or $15 million exclusion. I totally want that. Let's do it. Too often these like S Corp founders will look at this and try and make the switch like at the last minute. Like, I want to sell my C Corp here, my S Corp, and I've got a buyer here who wants to buy it here in the next 6 months. I'm going to switch to a C Corp now so that I can get this QSBS. And they think that will work. And maybe someone told them that would work, but it won't. The IRS routinely, consistently denies that stuff because you're not meeting that what they sometimes call it a vesting period or the time, right? That you have to hold it. And that it is just not enough time, right? It just gets blown up and it's just denied. They'll apply for it. They fill it out on the tax return. They send it to the IRS and they're super happy and they spend all their money because they think they have all this extra money and that it's not going to be taxed. And then, like a $700,000 tax bill shows up or a $2 million tax bill shows up and it blows everything up. It's very painful. So don't be that person, right? If you have an S Corp, great. They're wonderful, right? And if you want to keep that business forever and you never want to change, you never want to sell the business, then you should stay as an S Corp. But if you are planning to sell it, you're like, I built this thing, it's totally awesome, and now I want to sell it to somebody else so I can go retire on the beach or whatever, totally fine. You have to convert, right? You have to do what's called an F reorganization. There's a whole bunch of forms to file to make this happen, but you have to file this and convert it into a C Corp. Once you convert it, then you need, and technically it's a little more complex than that, right? So let me take a step back here. You take your S Corp and then you create a new C Corp technically, right? And then you contribute your old S Corp inside of the C Corp, right? So you move it up there inside to take that. Then that S Corp then is all the assets and all the business and all the, the goodwill and stuff like that you have inside of that S Corp is now owned by the C Corp. The C Corp then with those assets can then sell itself, right? After that 3, 4, 5 year vesting period, depending on what we're talking about. Okay, but the clock starts from the creation of the C Corp. It doesn't start from the creation of your S Corp way back when. It starts from when did I start this new C Corp? That's the key. Okay. All right. Next landmine to talk about. You have an LLC. You've been running an LLC. You love your LLC. Hey, but you're starting to get some new steam, right? Look at all these clients and contracts. Stuff's growing. This is awesome. Sweet. Let's do the thing. And you're like, oh, hey, I found, I built up this business and I'm making millions of dollars, but I'm tired, so I want to sell it and give it to somebody else. Someone's offering me a whole bunch of money to buy this thing. Maybe you built a software, you did some AI stuff or whatever, right? You have a really valuable LLC and you've been running it as an LLC for a long time, but you want to sell it now. Oh crap. I don't have enough time, right? C Corp issuance, right? It's a 3, 4, 5 year period. And if you try and sell the LLC outright, there is no exemption at all. It just doesn't exist. So you need to convert it to a C Corp. Well, how do you do that, right? Well, there's all these different things. You can file some forms and convert it to a C Corp. That's possible, right? I do that all the time. But that resets the clock. The clock starts from original C Corp issuance of that stock to the stockholders. It doesn't start from whenever the LLC existed, however many years ago. It starts from the conversion point, okay? So again, this is this timing variable. It's a huge deal. And I said this earlier, but these rules around the QSBS are not forgiving, right? You meet them or you don't, right? And if you meet them, you save millions of dollars in taxes and headaches and time and all. Like it's incredible. Very few tax strategies can even approach what this does, but only if you follow all the rules quite precisely. Okay, so how do you get around this one? And let me give you a scenario here where actually this landmine is very common. Now, a little bit more advanced for some situations, but how do I start this? Depreciation, right? So depreciation is when you purchase some kind of an asset and over time it's used, right? And that depreciation reduces the value of the home, right? Or the basis that you have in that particular asset. And basis is another one of those jargon words. It reduces how much value you have of the home. I guess we'll call it that. Now that depreciation most of the time applies to passive income. Well, most of the time what we're dealing with with QSBS stuff is active income. And if we make a lot of money on the active income side, all of that passive, depreciation means nothing, because passive income, passive depreciation cannot offset active income. So how do we deal with that? Well, there are ways of converting passive depreciation into active income. That's a whole nother conversation. We're not getting into all the details of how you do that, but it's possible. Okay. One of the ways of doing that is purchasing businesses. So in the scenario, I had a client come to me about a year ago now, and they had recently purchased an LLC that was owning a pool company, right? This is one of those qualified businesses, right? Because it's just a business and then they do pool cleanings all across their city and state. So that they purchased this business, but their intention wasn't because they love pools. Their intention was, look at all the assets that are in there. We can depreciate all of that and put it against our active income and save a whole bunch of money on taxes. This is a great tax strategy, which again, kind of outside what we're talking, the details of this, but this happens all the time. People purchase a business, they accelerate the depreciation on it, and then it offsets their active income. Okay, do it all the time. They had done this inside of an LLC, but then in my conversation with them, they said, yeah, we bought it, we're going to depreciate it and save all this money on taxes, and then in a few years, we're going to grow it, and then we're going to sell it off. And I said, brakes, hold on a second. You're going to depreciate this thing, and then you want to sell it? That's going to make your depreciation, your capital gains on that quadruple, because they purchased it for $3 million, right? This business. It's this $3 million purchase. They're going to depreciate it down to zero practically. And then they want to sell it. I'm like, if you sold it at $3 million, you're going to have $3 million, you're going to have taxes on a $3 million gain, right? Even though you're just buying it for what you sold it for, they're still going to tax it as if you made profit, even though you technically didn't. How do we deal with that? That's where this comes in, right? This idea. This is the C Corp and the LLC being created at the same time, right? So you can create a C Corp and then create the LLC. The LLC does the whole depreciation, business active, offset active income, that whole thing I just explained. And you can only do that through LLCs. That's important, right? You do that through the LLC, happy day, save a whole bunch of money on your taxes. But then you have your C Corp also at the same time. That C Corp clock starts at the same time, right? Same day. And then that clock is ticking in that C Corp. Because remember, it's only 5 years and it's original issuance and so forth. So for those first couple of years, that LLC may operate externally and the C Corp is operating externally. But then say year 2, you go shook and you put the LLC, you contribute the LLC to the C Corp. Now this $3 million business that you took a whole bunch of depreciation on, right? And got huge tax advantage. You just contribute that to the C Corp, right? There's no tax consequences for doing that. You just move it straight in. Happy day. And then you as stock people, right? That whole business, now your C Corp, which was practically empty and not really worth anything, is now worth $3 million, right? Right there. And you're growing it. So now maybe it's worth 5 or 6 or 10 or 12. And it's wrapped inside of this C Corp to then sell off and get, 10, 15, million dollars of capital gains exclusion. That was a little bit advanced, but hopefully that made sense. If you guys have questions about that, please post them in there, right, as we go through it. That's a little bit advanced, right? Purchasing a $3 million business isn't a daily occurrence for most people, but this is real stuff that you guys could definitely approach more quickly than you might think. It's not that hard to get these things. It's not like you have $3 million in your pocket. Hardly anybody has that. But you can get a loan from here. You can put a down payment here. You can do seller financing. There's all of these things that'll turn a $3 million purchase into maybe $200,000 or $300,000, right? From the get-go. And suddenly you have this huge asset that you can then depreciate, and then you can then sell off and have this capital gains. All of these things connected. Sorry. If you strategize correctly, right? And if you're planning for the future, if you're waiting and being like, oh, hey, I have this business, maybe I should sell it. I don't know. You're going to blow yourself up. It's not going to work out. But if you can plan ahead and say, hey, this is what we will do. This is the goal. This is how we're going to be in control and we're going to make decisions. This is a great path for a lot of people to offset a whole bunch of active income right now, today, and offset capital gains in 3, 4, 5 years or more, right? However long you hold on to it. So it's an amazing strategy and connection, making all that line up. Okay, so this is kind of this is another landmine, right? The state conformity. And I talked about this a little bit before, a little bit more details. If you happen to live in, Mississippi or Pennsylvania or New Jersey or California, right? It's a classic one. Alabama's another one. If you're in any of those states, you have a tax burden, right? If you don't have the federal tax burden, which is the largest one, so that's great, but you will still have a state burden, right, to deal with. Every one of these states calculates that differently, so I'm not going to get into all those little details there, but just understand that in most states, this QSBS is absolute, right? It is federal and state, and it's just exempted, right? So it's awesome. But in some of these other states, you will have a tax burden. And if you're not preparing for that, if you're not aware of it, okay, you're going to, pull all this money and you make all this money. It's awesome. Look, we sold the company, happy day. And then I'm going to invest it all, right, into the stock market and it'll be awesome. Oh, and then 6 months later, you have this huge tax bill. You got to pull half of it back out to pay this tax bill to the state that you weren't expecting, right? And then since you bought an asset, right, stocks or something like that, you bought it and then you sold it again in order to pay the tax bill. Now you've got another tax event because you bought and sold, right, within 1 year. So it's definitely something to be aware, right? The state conformity is a real layer to be navigating, okay? Another landmine, double taxation. Now, for those of you who have ever heard that phrase before, this is a common thing. This is a major issue, actually, with C Corps. Now, C Corps, there's a lot of kind of missing education about C corporations. So most entities, right, we're talking S Corps, LLCs, partnerships, trusts, things like that, right? Your like living trusts and things like that. Those are what are called pass-through entities. All the money might be reported at an entity level, but it really just lands on you as a person, right? It passes through the entity to you as income, and then you pay income taxes on it, right? So that's the flow on most of these. C Corps are different. C Corps, and there's like 300 years of history and court cases and precedent and stuff like that, C Corps. So they really are quite unique. But these C Corps, when the money comes in, they're like their own little encapsulated world. They are not pass-through entities. So you make $100,000 into a C Corp, and then you have $50,000 worth of expenses in that C Corp. Okay. You have $50,000 of profit just sitting there in the business. Okay. That's going to be taxed at 21%, just off the top. You haven't even taken any money out yet. There's already a 21% tax on it. Then when you pull it out to yourself, right, as a dividend to self, there's another tax on it. That's what we're talking about with double taxation. The entity pays a tax at 21%, and then you pay a tax on your income tax, again, right, on the dividends that come out. So when you look at the corporate tax rate, like 21%, hey, that's way lower than my personal tax rate. Let's do a C Corp. That's a bad plan because you are actually having to pay both of them. So it's not your income tax rate or 21%. It's your income tax rate and 21%. So running a C Corp in most situations is very expensive and not wise for most entrepreneurs, right? As you're just kind of running things. And especially if you're dealing with real estate, almost never is it worth doing, right? If you're running real estate. There are some exceptions, right? But again, outside of what we're talking about here. So why are we doing the C Corp issue, right? Well, because as I said at the beginning, the C Corp is the only entity that qualifies for this QSBS, right? It's the only thing. You can't do it in an LLC or a partnership or an S Corp. You just can't. It has to be a C Corp. Okay. Well, if I'm making money, right, from this business, because I hope I am, that's why I'm building the business, is to make a bunch of money. That money comes in, I'm going to get double taxed on everything that happens in there? Not quite, right? You could, right? If you don't plan well, you could be double taxed on everything. But if you plan well, you might have zero taxes. And that's what we're going to get into here for a second. So as I explained before, right? Revenue comes into the C Corp. Expenses go out of the C Corp, right? The profit that's left over is what's taxed, right? At that 21%. Cool. Well, what if I don't have any profit? What is 21% times 0? There's no taxes, right? If there's no profit, then there's no tax, right? At least at the federal level. So you make $1 million, right, in income, but then you spend $1 million in employee compensation or in benefits or in product or in, fixing the building or whatever it is, whatever your business is, right? That you're dealing with the pool example, right? You're purchasing new contracts, right? Or you are buying new equipment or whatever, right? All of those things, you just expense all that stuff, all of that stuff out. If you spend all of the money that you make, then there's no profit. And so there's no tax on anything, okay? So that's a very good strategy for sidestepping a 21% tax that comes right off the top of everything, okay? Well, how do we deal with the double tax, right? That second layer tax? Well, don't take any distributions. Don't take any dividends out. As the stockholders, the stockholders take dividends to themselves from the C Corp. But if you just don't ever take them out, then there's no double taxation because you can't be taxed on something that you never actually received. It stayed there inside the C Corp. Okay. So you can mitigate this double taxation again if you're planning and if you're aware that that is a variable to negotiate. And again, some of the details of how to do that, right? And the management and payroll and where are you investing that? That's a whole detailed, customized kind of conversation to have. But the basics of it are, sorry, my voice. The basics of it are that you can, right? You can avoid double taxation, which a lot of people aren't even aware of as a variable, but you can sidestep it completely while growing a multi-million-dollar business and getting paid for it too, and prepping this thing for a $15 million buyout or a $20 million or a $40 million or whatever, right? So there, again, planning, strategy, understanding the tax code, knowing how to play the game, right? And knowing the rules, the IRS code, the rules of the game can help you save crazy money, right? Okay. Oh, actually, sorry, I got ahead of myself. This is kind of what I'm saying right there. Zero profit operating pathway. It's the same thing. That's what I just explained. So if there are no profits, then there's no taxes. If you don't distribute, you don't send any dividends, right? Then there's no taxes on that. Hit year 5, you get all of this money, you get all of this payout, and you get all of this sale on stuff. QSBS applies, and you win. and you win the game. Okay. So here is 3 examples of the same thing, right? The same idea. So example A, this is post One Big Beautiful Bill, full 5-year hold, $15 million cap. Okay. The founder or founders, whoever they are, right? They hold the qualified stock for 5 years, just like they're supposed to. They follow all the rules. Everything's good. And then they sell the business. They find a buyer, right? And they sell the business for $10 million in total gain. Okay. Federal income, the federal total exemption possible is 15 million. They sell it for 10. So the entire 10 is simply excluded from taxes. They get to keep the money. They get to keep the money, but they don't have to pay taxes on any of it, right? $10 million of income, and you don't have to pay taxes on a penny of it in most states, right? As we talked about before. Huge. So example B. This is, I didn't get into the details of this, but we'll kind of touch on it here. Imagine we have one that is pre One Big Beautiful Bill, okay? Hold it for the full 5 years, as you have to, right? For the pre's. And then basis comes in, and that's like how much money you spent to own the thing, right? That's what basis is. Like, what is its your ownership of it? So the founder or founders, if there's more than one, totally fine. They hold that qualified C Corp for the full 5 years, all the time. It's great. The adjusted basis when they purchased it, right? So to simplify this, right? They buy it for $3 million, right? So they're already up a little bit, right? So we're at $3 million. Okay. Federal exclusion equals the lesser of total gain or greater of 10 million times 10x the basis. Okay. That's the key thing. So in this situation, right, with this pre-OBBA stuff, the basis is now what they use to do the math on. So it's not $10 million anymore. It's a $30 million exclusion. So $3 million times 10, right? So it's a $30 million exclusion. They could, the founders in this scenario, in scenario B, could sell that business for $19 million. And I just made that number up. But they could sell this for $19 million and have 100% of it excluded, right? Just completely money in the pocket, right? Example number C. This is again post, right? So they build a business, right? The founders show up, they build a business starting, let's say January 5th, or I keep saying January, July 5th, 2025. And they start building and it goes, and they get to, 2027 or so, 2028. And they say, you know what, I think we're going to sell this. Now they're only 3 years in at this point. Okay. So like, okay, if we do it at 3 years, we're only going to get half of the exemption, which puts us at, 7 million. But we have this buyer over here that we've been kind of chatting with for a little bit. He's saying like maybe 9 or so. Well, if we wait one more year, that gets us to the 4-year mark. Okay. So now we're at, 2028, 2029, depending on when they buy it, right? That pushes us from 7, right, up to 11. Now we're at $11 million exemption. All right, I think we can do that one. He's going to buy it for 9, or this, private equity company is going to buy it for 9 million. We get an exemption for 11. Sweet. Okay, we don't actually have to wait the full 5 years in that situation, right? We could sell it at 4, right, and step out because the exemption covers the total amount of what the sale would actually be. There's no need to wait the extra year to get more exemption that doesn't apply. Right? Because it wouldn't matter. The sale price doesn't change at all. Okay. So there's a lot to this, right? This is just 3 examples, doing high level kind of overview of how this works in general. But like, I hope you guys are seeing that this is untouchable as far as tax strategy works, as far as selling businesses are concerned. If you're a buyer and seller of businesses, this is incredible. Okay. Couple things that we're not touching on tonight, right? And I'm about finished here, just so you guys know. Things that we're not going to get into, right? We're not getting into Section 1045, 60-day rollover stuff, right? There's a whole thing, right? But that's very customized. It's very unique to your situation. We're not going to talk about stacking and using non-grantor trusts and all of that kind of stuff. Not going to get into that. Again, whole nother world of complexity. We're not going to get into like packing or strategizing that basis cap, right? Because we have that 10x thing that I talked about in one of the examples that pushed it up to 30 million. Well, if you start at 40 million and then you 10x that. Now we've got a $400 million basis, right? Exclusion potentially. Okay, so we're not getting into that because that is very complex. There's a lot of ups and downs. There's a lot of boxes to check. There's a lot of ways to do that wrong. There's a lot of ways to do that one wrong. But potentially that's like a real scenario, right? So it's not like you're only limited to 10 million, right? If all the boxes line up, this can be in the hundreds of millions, right? Of exclusion. Okay. Then another thing that I'm not really talking about here is kind of IULs. This is actually not part of the structure at all. It can be interrelated. And again, you can talk to Randolph about how that could work because this is a corporation. Right now, as a corporation, there are certain bonuses and benefits and things that can be paid to the executives of that corporation for certain reasons that can give you a lot of benefit. Now, again, not telling you to do that. I'm telling you to go maybe talk to Randolph and see if that maybe applies for your situation. But this is something that could benefit you in a lot of different ways and a lot of different directions. We're also not talking about family banks, which is one of the things that we do. We're not talking about trusts. We're not talking about LLCs. We're talking about a little bit about LLCs, a little bit about S corps. We're not talking about real estate investing, reasonable compensation, asset protection, employee leasing companies. Like these are all the other things that we do that we're just kind of jumping around and sidestepping, because this one piece is what Randolph wanted me to talk about here. And it, like I said, it's kind of untouchable. If you fit this mold and this matches what you're trying to do in your life, this is probably the best path for you to move forward and to do, because it will help out a ton in a lot of different ways. Last little bit here is just kind of action steps and next steps. So I built a checklist for you guys. If you guys want to like screenshot the page or whatever, right? Because I don't think you guys can click on this link at all, or maybe I can put it in the chat or something later. I got a link here, right? This takes you to a QSBS checklist. And it's only like 2 or 3 pages, right? You kind of look, okay, do I have this thing done? Yes, no. Do I have this thing done? Yes, no. Do I have this thing? Yes, no, right? So you can go look at that and check. Does it make sense for my situation? Am I planning maybe, let me to flip the frame on you guys a little bit, or maybe, are you thinking maybe a little too small? And maybe you should be doing this when you weren't really planning to. And maybe this is the right path to go forward. And we could do so many cool things if we did this. Just throwing that out there. The other thing you guys can download here is a QSBS calculator. It's just a spreadsheet with some kind of built-in formulas. You can put in, the acquisition date, your planned acquisition date, the basis, the holding period, all these different things, put in that information and it'll run the math for you to show you the potentially how much you could save and how much money you could keep and all of that stuff. So it's not exhaustive for all different scenarios, but at least it's a foundation, right? For you guys to kind of play with and see the math, right, of how certain things can work. And then that's a link to my calendar, right? If you guys want to get on a call, talk about this a little bit more, talk about anything else a little bit more. That's a great place for you guys to step in and we can kind of go from there. So right now, that's pretty much it. And I want to open up for Q&A if anybody has any questions. Let's see, I'll stop sharing. Do we see Mordor now? Okay, I can't tell.
Yeah, we do.
We do, good. And then, there we go. Okay, stop sharing.
All right, so Braden said a lot. He used a lot of big words, and he connected this to that, the hip bone to the knee bone, the knee bone to the shin bone, and it definitely does seem complex, and it actually is in a lot of instances. But that's why you have specialists. Does anybody have any questions about what Braden just shared? If you do, hit the raise hand, and we can unmute you. Let's see. All right, so we have a question from Don Sable. Said, you made it sound like there's no exceptions, but I want to ask just in case, what if you have an LLC, but it is taxed as a C Corp?
Good. Okay, so that's a very good question. And that short answer is that technically is possible, right? Yes, that can be done. I generally don't like doing that, but the IRS has said that they will allow that in this situation for QSBS. There's some technicalities, and basically what they're doing is they're saying, okay, the membership units that you have as the member of the LLC or members of the LLC, they will consider that or count that as if it were stock in a C corporation. Okay. And there's precedent for that that comes from the IRS. That one's clean. But the exception or the quirkiness of that is that often when people are playing with their LLCs or taxing them as C corps, they set up the structure differently than what is allowed for QSBS. So that's definitely like a dive into the details kind of situation. But is it technically possible? Yes, because the IRS considers that to be a C corp for tax purposes.
Okay. Did you have a follow-up question to that, Don? Did that answer your question? Any other questions? Okay, so Braden, what are real quickly before you and thank you for that. Is there any question? And because I'm pretty sure your presentation was very extensive and it considered a lot of things. Is there a question that people should ask that they don't think to ask?
What, like, in my experience, right, with this particular strategy, there's lots of other strategies, right? But with this particular strategy, probably the question needs to be asked to themselves. Say like, okay, do I want to do this? Right? Because grabbing a business and holding on to a business for 3, 4, 5 years can be harder than it seems, especially if you're not a business owner, right? If you're a W-2 employee, right, and you've never run a business, you've never done any of that stuff, it can be pretty intimidating to step in and say, hey, I've never done any of this stuff, but I'm going to start here and grow a crazy big business and sell it for millions. That might not be the best first step, right? So like there's some real introspection of asking yourself, am I ready for this? Because I have had some people who've come and they were already in the middle of a lot of pain on this, and it's been very hard to kind of dig them back out. So are you ready for it is the real question, right? To probably ask yourselves. And then if the things that I've touched on here are attractive and you're like, you know what, this would be cool. I can make sense. I can buy a business and grow a business. I can do these things, and or I can grow it on my own. Like I was on a call just earlier today, actually, with a client who is building a software company, right? So they have a very particular software wrapped around real estate. They've already got prototypes built. They've got a bunch of stuff going on, and their entire intention is build to sell. They have no desire to keep it. They just want to build it, use it in their own business because they do construction, and then they want to sell it. So they're already focused on, this isn't my life's work. This isn't something I want to keep around forever. My entire soul is not dropped into this. And if I lose it, I will have no purpose in life, right? I am doing this to sell it. And if you have that kind of a perspective on it, this is amazing. But if this is going to be your, this is my contribution to humanity, right? And I'm going to do this until the day that I die, probably not a good plan for that kind of a business.
Yeah, and I work with blue collar workers and white collar workers, right? People who get their hands dirty and people who work out their brain majority of the day. And one thing that I notice is a lot of the blue collar workers swear that they're never going to retire. They swear that they're going to be doing this forever. And then a lot of the white collar workers, they know the exact date and time down to the second of when they plan on retiring. But statistically, what ends up happening is the blue collar workers end up retiring or having to quit their business sooner than they expected because their bodies break down. And a lot of the white collar workers, for whatever reason, some of them don't have to, but most of them do end up working way past their initial planned retirement date, but they doing it in another capacity. I said all this to say this. I believe, regardless of what you think you want to do in the future, it's good to have options. And if you can start the clock on a C corp, if it's inside of your budget, and you can start that 5-year clock to the side, however Braden advises that it should be started, it's nothing wrong with having that option. I just attended relatively recently a mastermind meeting where what some of the people were doing to start their C Corp clock was they were putting a lot of their equipment inside of the C Corp, a lot of their employee stuff inside of the C Corp, because, really and truly, when you sell a business, a lot of the times you're selling equipment, you're selling the systems, you're selling all of that. And that way they were still operating over a more simple business entity with the public, but a lot of the meat was inside of that C Corp for whenever they were ready to sell it. Is that something that you advise, or not so much?
That 100%. That's something that can be done. And those are there are a lot of ways to play with this and make it really fit your situation. But you always got to be really careful on calls like this when I'm kind of introducing the concept, because I really don't want anybody to step out and try and go do it yourself. That's part of why I hit on those rules so hard. This is a very unforgiving strategy. But as long as you're within the bounds, you actually have quite a bit of freedom as to how you want to hook things together and what you're going to play with. And okay, we're going to do a pool company, or we're going to do software, or we're going to do, so many other different things, right? There's lots of different options of what you can play with, HVAC companies. But the key behind it is, I believe, is your intention and your own heart for it, right? If you're like, okay, I want to build something and then I want to sell it. And I want to sell it in a relatively short period of time, right? 3, 4, 5 years. If you're going to set up a C Corp today, right, and you're thinking about selling it in 35 years, that's actually not a good plan, right? You want to operate as an LLC or an S Corp or something. If you're going to do it for extended decades, right, for long periods of time, you want to keep it simple, right? Because there's a lot of additional kind of administrative burden to a C corporation. There's all that tax compliance you have to navigate constantly inside of a C Corp. There's a lot to a C Corp that I didn't even touch on. So in my opinion, and the way that these things usually function, C Corps I use them for two purposes for most of my clients, right? Right? The QSBS, they have a specific plan or a specific intention. They want to buy something. They want to sell something. They have an idea. Maybe they want to start the clock now for an idea that's being developed or something like that. Totally fine. But the intention from day one is, this is going to be sold. As soon as I can find a buyer and I meet all the qualifications for stuff, this stuff's gone. I'm building it to sell it. Which is not different mentally. It's not different than, I'm going to, paint a painting and sell it, or I'm going to build a house and then sell it, or I'm going to build a business and then sell it, right? There's no difference to it from the tax perspective and all that. It just needs to kind of be in the psychology, because if your psychology is not right on it, you're going to fight yourself as you go through the process. And like I said, long-term stuff is almost always LLCs and S Corps for long-term stuff. But for the short-term buy and sell kind of thing, C Corps almost always win.
I get what you're saying. Options are always great. But because they say the best time to plan your exit is at the beginning, right? Just like they say the best time to plant a tree was 20 years ago, right? But what you're saying is you got to be very intentional if you're doing a strategy like this. This isn't something, let me start the clock and wait and see. This is no, this is the plan. This is a plan that I plan on executing within the next 5 years, or maybe a little less, or maybe a little more. And I know that this strategy benefits me based off of what my plan is.
Exactly. And I used a lot of big numbers, and they're talking $30 million, right? $400 million sales. Most people never touch that money, and I'm fully aware of that, right? 99.9% of the United States is under a $30 million net worth, right? Most people never see that money, and I don't know if I will ever see that much money either, right? That's a lot of money to be moving around. But the principle stays in place. If you have, I don't know, let's do an HVAC company. I keep using that one, but it's a good example. Let's say you build an HVAC company and you install stuff. It's manual blue collar labor to get inside this house, install all the things there. Oh, am I still here? I just did like a reconnecting there for a second.
Oh, no, you're still here. We still see you.
Okay, good. I did a little black screen there for a second. But so let's say you're an HVAC installer, right? And you start your own business and you're coming in and you're installing heating appliances and all that kind of stuff, right? You're doing all this work, tons of work to do that. You've got a vehicle, you've got equipment, you've got all these things to pull this off and do this business. But then, I guess not, but then let's say you build it and it gets to say $1 million of total value, right? That's on there, or maybe 2 million. Right? Because there's a lot of equipment involved in an HVAC company. We're not talking 30, 40, 50 million, right? We're talking like one, right? Which is not hard to do at a business level, right? Even a moderate sized city, if you're working hard on these, getting a business like that, like an HVAC or a plumbing company, things of that nature, getting to $500,000, $1 million is not really that hard. Right. So if you're doing $1 million a year, right, in revenue, right, not in profit, just in revenue, $1 million a year, when you sell that, they usually factor in what they call EBITDA, right, which is they're just calculating how much money that you make. And then they maximize that over 2, 3, 4, 5, 6 years, right? They multiply it and say, okay, that's your sale price. So if you're bringing in $500,000 a year, let's say, they're going to multiply that by, at least 3, right? So you're talking 1.5 million, right, at that point as a purchase price, right? The taxes on 1.5 million, the capital gains tax of 1.5 million is a lot of money. You're looking at $150,000, right, of just taxes, right, if not more, right? Well, what if we strategize from the beginning and we say, I'm not going to reach this $30 million or this $10 million or even this $5 million point, but I might reach 1. It still works, right? This QSBS still works on even the smaller businesses. And that's $30,000. That's $100,000 of taxes that's just exempted, right? It just evaporates that you just get to keep it, right? I mean, and that's a down payment on a new property, right? You will save, even on like a $1.5 million capital gains, the exemption off of that is going to be at least a down payment on a rental property that can then bring you rental income for the rest of your life. Right? Just by excluding those taxes, right? And moving that stuff around. So again, the strategy and bringing the dots together, be like, okay, what am I going to do? This is over the long term instead of right now. Like what's living in the moment and not planning for the future is where a lot of the problems come. But if you can plan for the future, right, and see, okay, this is the path. I can do this and this, and that's going to cause this one. That's going to bring this one over here. Then I can benefit from that. This is a huge component all the way up to, $200, $300 million. So if you're underneath that, you can benefit from it also. There's a lot of benefits to it.
That's great. That sounds amazing. And speaking of HVAC, I know we got a HVAC specialist on the call, Brian Highsmith. So hopefully you got some benefit from that, Brian. Does anybody else have any questions? If you do, put it in the chat. If not, if you want to say it verbally, just hit the raise your hand. And then we can get you on here. And we're going to give it a 5-second count. 5, 4, 3, 2, 1. Braden, I want to thank you so much for your insight and advice that you share. And I know you have a lot of knowledge. You actually have a community called the Inner Circle. We put a link for people to join the Inner Circle. Braden teaches concepts like this on a monthly basis. And how many hours of courses do y'all have at this point now?
Oh dear, I don't
probably
even know.
Over 100.
Yeah, I was going to say hundreds. Yeah, probably. Yeah, lots of stuff in there. Tons of stuff.
Yeah, a lot of relevant information. A lot of the people that I work with, smaller businesses, larger businesses. I've worked with Braden on, and I'm pretty sure he probably works with even a lot more larger businesses than I've introduced him to. But yeah, definitely make sure you connect with him. This is the first Liquidity event online. Y'all, I'm pretty sure if you ran into any technical issues, make sure you know about it so we can be better next time. If you had any issues getting in, let us know so we can fix it. Next month, if you are in the Jacksonville area, I am doing, and we're going to put this on the calendar, but I am doing an estate planning event on June 21st. What are the dates? June 23rd. and June 25th at 1 p.m. Eastern and at 6 p.m. Eastern at the San Marco Community Center. They're going to be in person, but they're also going to be shot live. We will be sending out an invite for people to either watch it online or come in person if you want to come hang out with us in San Marco. But until then, I want to thank you. This is the Liquidity event online, sponsored by Shield Wolf Strongholds. You will be getting a link to give Shield Wolf Strongholds a 5-star review for sponsoring such a great event, if you feel so inclined. If there are no additional questions, Braden, thank you so much. All the members that visited, thank you so much. My team, Praise and Sierra, thank you for working in the background, and I hope y'all enjoy the rest of your evening. Good night.
All right, guys. Thank you all. Have a good day.